the script has sort of been flipped a little bit here. We started seeing a scenario where the growth versus value started changing as the stay-at-home versus the reopening trade started to change. And a lot of that, Brian, has to come back to interest rates, and we got to be watching interest rates very carefully. But there's a couple things that I want to point out specifically for all the viewers today. First, number one, very interesting trading. We had a 2% gap up on that Pfizer news on Monday. And then we started to see the market sell off at the end of the day. We have not seen in 25 years of data a 2% gap up and then close below that sort of gap up that we've seen in the past. Number one, that feels a little bit exhaustive, at least short term, sort of buy the rumor, sell the fact. The second thing, Brian, that I would point out is that inside of our work, and we've talked about this here with you for years, that when we see some of these internal readings either get to very large extremes, we want to start to really pay attention and perhaps start to lean the other way just a little bit. And just this week, we've got over 92% of all of our industry groups are now above a 40-week moving average. And Brian, when I was on this show in March at the lows, we were basically at zero. Zero of the groups were above a 40-week moving average, which typically marks a bottom. I've only seen this work go to 100% twice, and that was back in the 1970s. So the question is a lot of good news probably baked in? The answer in the short term, probably yes at this point in time. So these are some of the things we got to pay attention to.
It sounds like you're saying, Craig, sorry to jump in, it sounds like you're saying don't expect some sort of big end-of-the-year Santa Claus rally?
I think a lot of the good news is baked in, Brian, and I don't see a need to raise our 3,600 objective for 2020 right now. And then also to that point, Brian, I'd also just make the observation, if you look at what has happened between the NASDAQ 100 and also the S&P 500, we saw something very interesting happen. The differential between those two indexes hit a very wide reading, over 300 basis points. We haven't seen something like that happen since 2008. So again, another sort of question mark about is the leadership of this market perhaps starting to change? It's been FANG, but if this market starts to rotate and starts to change, with FANG stocks being such a large part of the index, can these indexes hold up? That's the question for a lot of the viewers here today.
Yeah, we've been asking that for a long time with all those big name stocks, 30, 40% of the market. But as Jim Cramer likes to say, it's a stock market and a market of stocks. There are names that you like. Let's blast through one or two of them in the time we have. Chipotle. Everyone's going back to the burrito, Craig. What in the CMG chart looks good to you?
So I look at the CMG chart. It's just sort of kind of a corrective pullback at this point in time. Longer-term trend is still there. That should still be bought at this point in time. We do remain overweight to consumer cyclical, healthcare, and tech at this point in time. And I also think that companies like Cirrus Logic should also be bought, and also HCA. Those are stocks that are breaking out, and we can find positive things to buy. It just may not be those 5 largest stocks or the FANG stocks at this point in time. So we need to be more selective, and I think that's going to be the key going forward.
HCA, Cirrus, and Chipotle, very quickly, DocuSign, you think it's done? It's finished. It's made a lot of money, and that's it.
You know, Brian, I think the growth story is still there. Nobody's going back to sign paper, documents again. But what probably could happen is we could see a scenario where the PE multiple starts to contract, and hence we go.
Shepard Smith here. Thanks for watching CNBC on YouTube.